Hi, everyone. I'm Rick Bensignor. Today is Tuesday, November 1st, and welcome to this week's In the No Trader Show. What do we have on tap for you in order to get us going this week? Well, in our trader education portion, we're going to pose the question, is there a way to be fully invested in the S&P 500 macro sectors and still crush the spider's return? And then in our sector portion, this week we'll actually look at the 11 spider macro sectors that are the ETFs that track the 11 sector indexes for the S&P. Before we start that didn't belong in here. Let me tell you about the products that we have for you. We have a weekly tactical trader report. It comes out Thursday evenings. And what it does is give you a very broad background of what's going on across the major asset classes. So we focused on the US bond market. Often we'll take a look at credit spreads also to see what they're showing. We'll take a look at the US dollar, often gold or oil as part of that picture, and also a deep dive into the S&P 500 as far as what I'm thinking about the overall market. Where should rallies run out of steam? Where should sell-offs find support, and so on. Then I give you a brand new trading idea each week in an ETF space. It can be anywhere across any ETF. Usually I try to pick liquid ones, but it can be a commodity-related ETF. It can be a stock-related, anything, anywhere. It can be fixed income that we think we have a good opportunity of making money playing either long or short. Sometimes they do pair trades too. We'll do a sector versus a sector. We've had very good results doing those. Finally, I will walk you through all open trade ideas that we have until we close them out, and we do that every week. The other report we have is a monthly 7-Eleven report. In fact, one just came out last night because today is November 1st, and what this report does is try to outperform the S&P by being in no more than 7 of the 11 sectors of the market in any given time. We have updated results because yesterday was the end of the month. So last month, we again outperformed in the month of October by 90 basis points. That's 0.9%. Cumulatively for 2022, we are outperforming the S&P by 5.14% in the 10 months so far this year. We've outperformed in 9 of the 10 months, which you will be hard-pressed to find anybody do. And since we started this report in August of 2020, which is now 28 months ago, we've outperformed the S&P by 10.98%, essentially 11% in less than 2 years, simply following the recommendations we make to be in which sectors. If you're watching this, you're probably watching this on my YouTube channel. You have the opportunity to subscribe to it through YouTube, which basically what that does is when you open YouTube and subscribe to our channel, then any other future time you open YouTube, my most recent videos will be right on top of your screen. So that is something I recommend you do. And of course, if you haven't done that yet, go to youtube.com/inthenotrader, and that'll bring up the videos that I have. And then you can click the follow button, and of course, follow me on Twitter, and my handle is InTheNoTrader. So what I want to talk about this week is, let's go back here and talk about, is there a way to be fully invested in the S&P through the sectors and still crush the spider's return? And the answer is yes. So what we're going to do this week is actually take a look at what the 7-Eleven report is and why you should consider subscribing to it, because if you have money in spiders, in your, whether it's a 401k account or a taxable account, but if you have passive investments in the broad index of the S&P, for a very small amount of money per month, you can get access to my calls on which sectors to be in the S&P collectively, and therefore have the chance to outperform. And again, that's what we've been doing. If we're up over 5% this year, and we're up essentially 11% in the 28 months since we started this, that also means last year and half of the year before we outperformed, and those were up markets, and we've outperformed in those, and we've outperformed in the down market this year. And I can tell you it's not an easy thing to do. And this, of course, is the game that most money managers try to play. Any mutual fund that's a broad-based mutual fund probably has the portfolio's benchmark is the S&P 500. And so all these actively managed funds out there, the goal is to do better than the market, yet very few people can. And what I'll show you is what this report looks like, how user-friendly it actually is, and why it really does pay to consider this as part of how you approach the market, understanding which sectors to be in at any given time, with the goal to outperform the market. And that is what we're doing in either direction, and we're doing it over time. And you can even see the consistency this year. 9 of 10 months of this year, we have outperformed the S&P. So let's take a look at what this product looks like. So I'm going to go back a couple months and show you the September one, just because, again, the November one came out just last night. And if you're a subscriber, you've already received it from me. But I want to show you, one we did a couple months ago, just so you get a sense of what this report is. So again, it's called the 7-11. I came up with that because it's 7 sectors out of the possible 11. The goal is clearly to beat the performance of the S&P. So this is all about relative performance. It is not about always making money. So in a year, let's say where the S&P is down 20%, we are down less than 15%. Now, we're still down, but we are way ahead of what the market is. Prior years, let's say when the S&P last year was up, 28%, something like that, if I recall, we're up over 31, 32% last year. So we're outperforming in both directions. But I do want to make it clear to you, this is not intended to make money regardless of what the market is doing. This is to do better than the money you have invested in the S&P index itself. So we'll show you how each one of the 11 sectors did from the prior month, as well as the S&P. So for instance, the returns for August, the S&P was down 4.08%, and you can see how the other sectors did. And then I'll show you the relative rotation graph, just so as you're starting a new month, you get to see where the flows are and what's kind of doing well and what's not. But the crux of this report really ends up coming through each one of the charts of the 11 sectors with what my call is on a relative basis. So for instance, we were neutral materials in September. We had just actually upgraded, I remember this, we upgraded it in August because we had had this as an underweight, which obviously worked out very nicely. And then we came in and turned this into a neutral. So materials, it was holding on to the trend line. It was a place that I could expect some consolidation and a potential hold. And that's why, we were in the neutral stance. And I give you kind of my reasoning for the calls that I'm making. So you'll always see a relative chart of any one of these 11 sectors versus the S&P through the spider. So the dark black line is whatever sector we're looking at, in this case, XLC, communication services, divided by the SPY, and this is a chart. So communication services have been selling off since fourth quarter 2021, And now it's, it's a full year of virtually straight underperformance. And this is not one of the sectors that make it into the 7 that we're holding, because I've continued to look for further underperformance, even with some of the counter trend signals that we've seen along the way. I was looking at a broader picture, understanding also which names make up the biggest weighted names in these, and do analysis on those charts too. So it helps me pick my overall view by looking, into some of the key names. And we go through energy. So for instance, we went long into energy in July or August, I can't remember, of 2021. So we picked this bottom right here to put this into our portfolio. We sold 30% out of it on the high this year, and then came back and put 10% back in right against the support level that ended up holding. So I am actively managing this portfolio on a month-by-month basis. Only once in the 10 months so far did I do an intra-month update where things had moved so much that I needed to adjust. But generally, my goal is to get you into a sector, usually for months at a time, and to ride them as best we can in order to capture the next trend that I see. So if it's made it into the portfolio, generally it's because I think it's outperforming, or at least will stay neutral and will not underperform. And I go through the financials, holding up against support. So this is in the portfolio with a minor overweight. We're leaning bullish. We're not fully bullish, but we lean bullish. And again, this is back essentially the September 1st report. And we go through industrials, which I've been neutral on, trading in a channel, and neutral technology. And at the time, again, I leaned bullish, so I moved consumer staples up, having bounced off the trend line and seeing, the bigger triangular pattern that had stalled against the 13 against prior highs, but I leaned it to bullish, and that's worked out well too, because staples have outperformed over the last several months. Real estate, I had moved down to a neutral. It had been a lean bullish, and so on. So, I go through all the sectors, and then we get to the page of what to do for this coming month. So I show you, obviously, the name of the sector, the ticker for the particular sector, what my rating is, what our quant model's rating is, and sometimes they're the same and sometimes they're not. The quant model is a terrific way of bringing fundamentals into the equation, whereas I'm more inclined to look at charts, but I certainly don't think you're going to have a high likelihood of outperforming the market over time simply looking at technicals. So we bring a quant model in too, and to me, without a doubt, this quant model is 20 years running, I think, the single best quant model that exists. And therefore, I look at both my rating, the quant model's rating, and come up with what my ultimate decision for you to be in or not, and by how much each month. So you'll see there's no allocation to XLB back in September. There's no allocation to XLC. You'll see that, for instance, energy, the third line down, I lean bullish. The quant model leans bullish, but they use the term of lean overweight. The benchmark weighting, so the actual weighting that the S&P, the energy index is in the S&P is 4.6%, but I recommend it to be long 8%. So obviously we have a strong overweight feeling towards the energy sector, and we're allocating almost a 2 times benchmark weighting to energy. Financials has a 10.8, so we'll call it 11% benchmark in the S&P as of August 26th. We told you to go in 12%, so just a little bit of an overweight. We're not in industrials back then. Technology is 27.5%, so rounded to 28%. I'm neutral. The quant model at the time, again, this is several months ago, was leaning overweight, but I decided to keep technology in the portfolio but simply at benchmark weighting. So if it outperforms, we're in it. If it underperforms, we're in it, but it's at the actual benchmark weighting. So it's not contributing or hurting per se in relative terms. Staples, you can see we at the time we're long 9% versus roughly a 7%. We were not in real estate. We had a double weighting in utilities, 3.1. We were in it at 6%. Healthcare at 14% of the S&P. We're in at 24%. So that's 10/14 or 5/7 bigger weighting. That's like a 70% overweight in healthcare. And consumer discretionary, I was just 1.5% above its benchmark weighting. And this is one of the times that I was actually leaning bullish consumer discretionary, and the quant model was leaning bearishly. And usually that would either keep me out of it or put me pretty much at neutral. And you can see we're virtually at neutral. We had lowered it. This last column tells you what the change in percentage was from the prior month. So we took 2% away. So the prior month we were at 15%. We lowered it down to 13%. So this is the key page, page 17, that shows you how to allocate for the next month. So you take your total amount that you're going to put into spiders and just break them up percentage-wise into these proportions. It's a once a month simple calculation. And obviously, we're doing a heck of a lot better than you're simply being in the S&P. The next page shows the monthly sector rankings. So rank number 1 here in kind of this teal green is the sector that we have the most weighting to. And you can see since the beginning, every month we have more weighting in tech than anywhere else. And that kind of makes sense unless you're really bearish tech, because the weighting is 28% of the S&P. So at one point we had about 36%, 37% looks like is the most I've been. But 37% on roughly 27% is not as big as it sounds. But because tech is such a big part of the overall market, it's a large percentage of the whole portfolio. But you can see the changes, and you can see for long periods of time, like here, if we look at Staples, from August 1st, 2020, when we started this, I was never in Staples until April of this year. And you can see something like healthcare. We were in when we launched. We then took healthcare out for the bulk of 2021. But on December 1st last year, we went into healthcare. And you can see the increases over time that we're up to 24%. And this has been a great sector. Our timing to get into healthcare was perfect. In fact, if we go back to the healthcare, let's see, I'm just going to guess here. So let's farther forward. Utilities, here we go. So if we look at this, we went in December 1st last year. So somewhere in this range is where we went overweight, and look at the move since. So obviously it pulled back recently, but we caught the bulk of the up move by properly timing and doing the analysis on the sector in order to determine when to get in. So then we show you month by month, and in every report, I show you the total history of everything we've ever done in this 7-Eleven report. So this first slide here, slide 19, shows you year to date how we're doing. So in 2022, you can see month by month what the S&P did and what we did, the value of a theoretical $100,000 account, where you would be. So at the time in August, you were up 87,000. The 100,000, because the market was down this year, was down to $87,000, but the spiders were down to $83,500. Again, outperforming at that time by 3,400. We are currently outperforming, like I said, this year by 5.14%. So on a theoretical $100,000 account, you're up $5,100 above what the S&P was up by listening and following us. You can see here the chart from the start of the year. It's a down year. So both the 7-Eleven is down, and in orange is the spiders, but 7-Eleven doing better. And here's the P&L in dollar terms of how you would be doing, the value increase in the account relative to what your account would be if you had the S&P 500. And then we do one last slide here is the total return. So we do the same thing, but now we go back to day one that we started this report with every statistic from every month so that you can see there's nothing hidden here. There's no BS. This is as simple a way to track what we've done month by month since inception and look at the P&L over time. You start on the lower left, you're on the upper right. At this point now, it's well higher because now you're up 10.98%. So on a $100,000 account, you'd be up essentially $11,000 better than being in the S&P. So this is a home run, folks. Now, can I guarantee in the future that the results will be as good? You know I can't. Have I been consistent over time such that we keep chipping away virtually month after month? You can see there are some down months, but overall, we just this, and anytime you want to look at statistics of fund performance, you want to see exactly something that looks like this, that just grows over time with very, very small drawdowns along the way. So that's the 7-Eleven report. Again, a new one just came out today. So if you sign up and subscribe, you get a free 7-day trial, which means I'm giving you access through my website to the report that just came out today. If you want to, you have 7 days to look it over before your charge card, your credit card is charged. And I'm giving you, a free look into this. But I can tell you, based on our numbers at In the Know Trader, once when people sign up, very, very few ever cancel because the performance is so good, and you can't find this type of performance elsewhere while being invested in the market. There are some right now, and I'm still working on trying to create an ETF for this. And there are some tactical ETFs, but you'll notice that they can't come close to these type of returns. And some of them are not even in the stock market. What they do is shift to bonds or precious metals or somewhere that they think they have a hedge. And meanwhile, bonds have had a disastrous year as far as return, and metals have done nothing. Now, obviously, the gold market, let's say if you were in gold, is not down as much as 20% the way the S&P is. So it's a hedge in that respect, but you're not in the stock market. This is one of the only places that you are going to be fully invested in the stock market with the consistency of outperforming the market month after month. So that's what I wanted to share with you today about the 7-Eleven report. And of course, I want you to be a subscriber, but I'm not just talking off the top of my head and say, just subscribe to Rick's thing. I prove to you time and time again and show you all the statistics. And you can see these, and you can watch this and freeze the video you're looking at now so you can look at each month. These are all done through Excel spreadsheets. So I just input how the 7-Eleven did each month and what the spiders did, and everything else gets done automatically. So there's no chance for, or let's call it virtually no chance for human error in this. I'm telling you about this because if you followed me for the years that I've been doing this, that my goal here is to help the individual investor do a heck of a lot better than they can do on their own through using really high-level institutional models and ways of looking at the market that the average person doesn't have the experience or the know-how to do. I'm on Wall Street now over 40 years. I feel proud of it, and I also think to myself, wow, 40 years is a heck of a long career. But I have been a commodities trader in the pits for my first 12 years. I've been on the sell side. I've been on the buy side of Wall Street. So in 40 years, I've played all the angles. I've been a portfolio manager. I've been selling to portfolio managers. I understand the business from all sides. And I can tell you that you will be hard pressed to find anything like this type performance while being 100% in the stock market and still outperforming like this. Okay, let's now quickly go through the 11 sectors of the market. So I'll just give you my view. These are not in relative terms. These are just outright. So let's go through these here. And I do them alphabetically because they're XLB, XLC, so I just make my way through them that way. These are real time right now as we record midday on Tuesday the 1st. So you can see this week, which just started yesterday, the XLB has now hit its downtrend line from the highs. You'll also notice if you start to understand cloud charts, you'll see the little pullback on the lagging line, which is nothing more than current price pushed backwards in time, is kind of stalling at the same level that the last low was last year before earlier this year before it rallied and then broke through the cloud and then went into sell mode before selling down to the 200-week moving average. So like many of these, including the S&P, we went to the 200-week moving average. Materials did the same thing. They've bounced, but they are up against resistance, both from trendline resistance and from where the prior low close was before the breakdown. If it pokes through from the current 74 and change, look for 77.5 or so to be the next level of resistance. And support probably in the 72 handle down to, I guess, the 200 week again. All right, XLC, communications. So obviously this has been a nightmare. This is Google and Meta, the two biggest names in these in this SPDR ETF, and the cloud model was super helpful here in shifting from bull mode to bear mode. Sequential 13 on the all-time high. This entire sell-off has not had one sequential, so not even a 9 count on the way down, like the S&P. But this is a disaster relative to the S&P too, because this just keeps going down, down, down. So we're getting closer to some theoretical support, which is at 42 and change down to 38 and high change from the COVID bottoming process. But this has been a nightmare, and sooner or later it'll get some trading bounce, but tough to make a real case for why this is going to start to outperform. And again, this is just the outright chart. XLE energy, certainly going to be one of the better looking charts. It's had great relative performance. It's outperformed the S&P by I don't know, 80%, something like that in the past year. Last week is a sequential 13. There's some follow through buying this week. We are against the risk level from this 13. It's kind of hidden in here. Let me blow it up a bit so you can see it. The red 13 that was in here. So the all-time highs were made again. Well, no, these may not be all-time highs. I would think years ago. Let me see. Was this better? Yeah, it's not the all-time highs, but certainly the secular highs. So we have another 13 now, and we're starting to get up into resistance. XLF financials bounced on the 200 week and the TDST line. It has broken above its weekly baseline, whereas the S&P has not. This has. So again, kind of tells you there's relative outperformance here. We could draw quickly a trend line from the high. Let's put it to here, and so we're getting close to testing there, and the highs from August. Not quite there yet. If it breaks through, let's put up a propulsion and see if there's any. So yeah, just above the trend line is a bullish propulsion level at 35.64. So you'd have to properly get above that on Friday closes to really have a breakout. I'm not convinced that's going to happen. XLI industrials had a good month in relative terms. Also pretty, bounced on the June lows were on the 200-week moving average. We made slightly lower lows but quickly turned around. It's going to have resistance between kind of 98 and just north of 100 or so. That's one to watch going forward. XLK Technology certainly has had its troubles recently with some of the big cap tech, struggling. Same thing. We sold right to the 200-week moving average. We've bounced. It's still beneath its baseline at 132.5 or so. So that would be the next resistance point. This is a tough call. What you don't really want to see are any material new lows. That would open the door for all kinds of trouble. XLP Staples. They actually bottomed on a 9 count. Bar 8 was actually the lowest low. It's perfected because bar 8 or 9 was the low of the move. We got a good bounce, just like we got a bounce back in June from there. We're still beneath, if I eyeball this, it looks like, yeah, we're still beneath the downtrend line from this year's high. So you're going to have resistance up in the 74, 75, 76 level going forward. If it can break the trend line, you still have the cloud to deal with. So that's the latest picture there. XLRE is real estate. The 9 count on the bottom obviously broke well beneath the 200-week moving average, broke beneath the TDST line. Let's see, did not get a qualified break beneath it, but it was certainly, percentage-wise enough that you probably would have gotten out. Do have a bounce on the 9. Look for resistance anywhere up to about $40 or so. That's going to be hard to get through. XL, what do we have? Utilities. Utilities also bouncing, one weekly close beneath the 200-week, strong rebound. This is going to start resistance at 69, and that's going to go all the way up to 72 or so. So that $3 range is going to be tough going. You've got to get multiple Friday closes above 72 for this to break out on the upside. Healthcare, XLV, one of the better charts. We're near some of the higher highs over the last several months. You really need multiple Friday closes above 136.22 to potentially break this out on the upside. New lows this year probably sends us all the way down to the 200-week moving average. So you got to be careful about that. And lastly, XLY, consumer discretionary. So the first summer low, or actually the June low was 1 week after a 9 count. Here we had 1 week before the 9 count was the actual bottom. So we come back up to the 200-week moving average, 2 weeks in a row, kind of pull back from there. It's going to have, even if it gets through there, 150 and change to 154 is going to be resistance. So on a lot of these, what it really tells you to is that you don't want to see new lows because that opens the door for much more significant low. That's it for this week. I hope you enjoyed the show. I'm Rick Benson, and thanks for watching In the Know Trader.